When working in a KYC AML role, the term SAR is bounded about and everyone knows what it means. But to us everyday people, we have no idea what it is, or of its importance. In today's video, we will be taking a look at what is a SAR, when to submit one, and the consequences of not submitting one. Hello and welcome to another KYC Lookup video where we bring you AML related content to help you enhance your knowledge in the fight against money laundering. Before diving into today's video, be sure to subscribe so you don't miss out on any future videos. Oh, and don't forget to leave us a comment with any suggested topics you would like us to cover in the future. We also have a special announcement to make, so be sure to watch until the end to find out what it is. So, on to today's video. What is a SAR? In financial regulation, a suspicious activity report, or SAR, or suspicious transaction report, STR, is a report made by a financial institution about a suspicious or potentially suspicious activity of a client, which may indicate money laundering or terrorist financing. Who would submit a SAR? A suspicious activity report, or SAR, is a document that financial institutions and those associated with their business must file with the Financial Crimes Enforcement Network, FinCEN, whenever there is a suspected case of money laundering or fraud. For example, if you have a client and you notice that they have many layers to their business that just don't make sense, or if their source of funds or wealth isn't very clear, then you should consider filing a Suspicious Activity Report. Suspicious Activity Report was originally provided by the Bank Secrecy Act, BSA, of 1970. Originally called a criminal referral form, the SAR became the standard form to report suspicious activity in 1996. Mainly used to help financial institutions detect and report known or suspected violations, the USA Patriot Act expanded SAR requirements to help combat domestic and global terrorism. When to submit a SAR? It is always advised that as soon as you know or suspect that a person is engaged in money laundering or dealing in criminal property, you must submit a SAR. However, caution should always be taken. Just because it appears there may be a criminal act committed doesn't necessarily mean there is any wrongdoing. The client may have a good explanation as to why they have their affairs arranged in a certain way. When submitting a SAR, you must not tell anyone, not even your manager, as this will lead to you possibly tipping off. If, however, you know for certain that a crime has been committed, and then you choose to do nothing about it, you yourself would become complicit to the act, and if found out, will suffer severe penalties or possible imprisonment. Why is a SAR required? A SAR is a really key piece of information to help law enforcement agencies to uncover and prosecute significant money laundering, criminal financial schemes, and other illegal endeavours. SARs give governments an opportunity to spot and analyse emerging trends and patterns across a broad spectrum of personal and organised crimes. With this knowledge, they can anticipate and counteract fraudulent and criminal behaviour before it gains a foothold. What is the consequence of not using a SAR? As mentioned previously in the video, failing to submit a SAR when necessary can have detrimental effect on the business you currently work for. Fines or even imprisonment could be a penalty, both of which will lead to big reputational damage. For example, in 2020, Deutsche Bank allegedly failed to disclose more than 1 million suspect money transfers from Danske Bank Estonia, for which Deutsche Bank was a correspondent bank. The suspect money transfers occurred over a 5-year period, after a whistleblower at Danske Bank had flagged them as suspicious transactions. German prosecutors launched an investigation to determine if Deutsche Bank employees had sanctioned these transactions and whether they had subsequently attempted to cover them up. Deutsche Bank withdrew from its position as a correspondent bank for Danske Bank Estonia over increasing concerns about potential misconduct by Danske Bank, and launched 2 internal investigations into the matter under the scrutiny of US regulators. Frankfurt prosecutors cleared Deutsche Bank of money laundering, but found that between 2010 and 2015, the bank had failed to send timely alerts of potentially suspicious transactions to law enforcement authorities on 627 occasions. For each of these failures, Deutsche Bank was fined between €12,500 and €30,000. The total fine was a staggering €13.5 million. In 2017, HSBC was also fined an eye-watering £91 million for unacceptable failings in its anti-money laundering systems. The Financial Conduct Authority, FCA, said weaknesses in HSBC's financial crime safeguards had been highlighted several times before action was taken. The bank has not disputed the findings and agreed to settle, resulting in its fine being cut from £91 million to £64 million. HSBC's failings cover a period of 8 years, from 2010 to 2018, the FCA said. The regulators said there was inadequate monitoring of money laundering and terrorist financing scenarios until 2014, and poor risk assessment of new scenarios after 2016. Europe's biggest bank was found to have inadequate testing and did not check the accuracy and completeness of data. But this has not been the first time HSBC has been fined. Previously, they received a fine for failing to detect a customer's imprisonment for smuggling cigarettes into the UK, and ordered to pay £1.2 million by the HMRC tax office, where the bank missed a sustained period of unusual activity, the FCA said. And in 2012, it paid $1.9 billion, that's £1.5 billion, after an investigation by the US Department of Justice for failing to prevent laundering by Mexican drug cartels. The bank then agreed to be monitored by US regulators for 5 years. Not only do these and other banks receive fines, but this also leaves a bad taste in the mouths of the public and creates a huge distrust in the companies entrusted to take care of our finances. This also discourages future customers wanting to bank and do business with them. Well, there you have it. A quick introduction into what is a SAR, when to submit one, and the consequences of not submitting one. Please tell us in the comments section what other requirements you think are needed to submit a SAR, and if you think they work on combating money laundering. Now for the special announcement mentioned at the start of the video. We now have launched our very own courses for you to take a more in-depth look at a variety of subjects, such as Introduction to AML, Beneficial Ownership, and Customer Risk Rating, for example. So make sure you visit our website for further details, and let us help you connect the dots in KYC. Thank you for watching the video, and if you made it this far, don't forget to like and subscribe to watch more amazing videos.